Mark, very good morning to you. So we're busy waiting for non-farm payrolls, 1.5 non-farm payrolls, looking at US futures a little bit weaker, weighing on sentiment for tech here in Europe as well. What do you make of the price action heading into the important data print?
It's been very disappointing price action, and I think this kind of choppy price action with a negative bent is going to be the dynamic for the festive period. I don't think it's so much about the jobs data. I think the jobs data today is a great one for short-term traders, but it's one we'll quickly move on from. The dynamic here is that on one hand, Powell has emphasized that he thinks that the prior jobs data has overstated the health of the jobs market, therefore increasing the scrutiny and in the importance of these numbers given the data vacuum before. On the flip side, he also warned that this one's vulnerable to some kind of technical distortions, which means people will get very excited in the short term and then a week later, if it doesn't suit their view, they'll move on from it. The price action is very negative out there, and I think that's going to remain the case until we see the full pain play through on the digital asset treasury companies, which are really at the lows. And that's what's really weighing on the crypto sector, and in turn that's weighing on the retail sentiment, which is then hurting the big AI names or the more meme-focused AI names as well.
So, Mark, putting the possibility of a Santa rally aside for now, are we going to see more record highs for stocks in 2026?
Absolutely. I mean, I remain very bullish for 2026. I think, we've got everything in the mix for stocks to make significant more gains in the first part of the year. I think we've got the Fed providing easy monetary policy. We've got fiscal stimulus coming from the US, from China, from Japan, from Europe, kind of in all directions. We've got growth still holding up largely okay. We've got just a massive AI bubble, but we're in the inflation stage of the bubble. So that's a positive factor at the moment. It won't be forever, but it is very much so at the moment. Earnings still holding up good. And because that AI capex spending, that's helping the economy, even though it's a K economy, it's helping that kind of spending out there. So I think global stocks go much higher in the first half of next year. But I think it's too early to get excited about looking at that just yet. I think we've got some choppiness for the next couple of weeks.
OK, and thinking about that choppiness, Mark, might some of that come from shifting expectations about rate cuts? I mean, how convinced are you we get more rate cuts from the Fed? The market sometimes pricing in one, sometimes two. But this is into an AI boom, and it's in the context of much more of a hawkish tilt coming through from other global central banks.
Yeah, absolutely. I think one of the themes of the last month or two is the idea that most central banks are kind of at the end of their cutting cycle and going to be shifting towards hikes. And we're seeing that all around the world. And that's kind of changing the dynamic everywhere. We're in a world where people have a nagging feeling, it's not the dominant theme, but a nagging feeling that there are fiscal threats everywhere and too many developed market economies are over indebted. And therefore that creep higher in yields from these central banks moving more hawkish, the idea that inflation is sticky, it's a global theme. And that's why, even though we've seen 175 basis points of rate cuts in the last couple of years, we see 10-year yields higher than they were 2 years ago. And I think that's the dynamic we've got for 2026.